Hey everybody, welcome back to Drawbridge Finance. My name's Levi, and today I am talking about the gray area between passive and active investing. Today we're going to jump right into this. We've got Alice, Bob, Charlie, and Doug, and our four characters are going to take in different investment strategies in purchasing a home. Now, all of them have, say, $100,000, and they're just going to buy a house with this $100,000. So all four of them are going to take a slightly different approach, and they're going to have varying degrees of risk and varying degrees of passive versus active investing. So Alice, what she does is she buys a house that already has a tenant in it. She pays the $100,000 and immediately starts collecting rent. She does no renos, she does nothing. The tenant that lives there stays in the house, and she has generated passive income from her $100,000. Bob takes a slightly different approach. He buys a very similar house, it's $100,000, but he decides he doesn't want to rent it out at all. He wants to keep it in perfect condition. He doesn't want to have renters in it. He doesn't want to have the headache of having renters, and he is just going to seal it up, and he is going to sit on it and wait for the property value to increase because he feels that he's purchased in a good area and it's going to be worth more someday. That's his strategy. Super passive investing. Once he's made that purchase, he will then wait until the time when it is greater. His risk, of course, is that the property value actually decreases while he's not collecting any income. So he has a completely different risk profile from Alice. We don't know which one's going to pay out, but we know that Alice is collecting rent and her home value might be increasing, it might be decreasing. Bob is not collecting rent and his home value may be increasing, may be decreasing. Two similar but different risk strategy approaches. Now let's look at Charlie. He purchases a very similar house to Bob and Alice for $100,000, but he decides he wants to turn it into an Airbnb. He thinks that by having short-term tenants, he will make more money. So he has a different risk strategy as well. He might make more money per night, but he may not have as many nights booked as, say, Alice. Likewise, he might incur more damage to the property than, say, Bob, who's not letting anyone live there. Bob's house will stay pristine, whereas Charlie's house, starts to get damaged, and that may actually decrease the value of his home. So he has taken on a different risk profile than both Alice and Bob. Now let's take a look at Doug. He wants to use his $100,000 to purchase a home that is worth less than $100,000 and then do home improvements on it. So he finds a home that has not been renovated, it's a little bit run down, and he buys it for $50,000. He then takes his remaining $50,000 and pays contractors to renew that house to its previous glory and increases the value so that he can sell it at a future date. So he is hoping that the value of the house will increase over time because of the money that he's put into it. This is a very active type of strategy. It requires a lot of work. Similar to Charlie, Charlie and Doug have both taken on an active role in generating their income, whereas Alice and Bob have taken a more passive role. So you can see that passive investing and active investing aren't really black and white. We've got a lot of gray area. There are different ways to make money, and we have to associate the amount of time that we want to spend, the amount of money that we want to spend, the amount of effort that we want to put into generating that income. There are really easy passive investment strategies for like growth funds. I mean, we could be buying Apple or Amazon stocks right now. They're basically in a race to be worth $1 trillion each. Both of those are easy plays for growth. So that would be Bob's strategy, which is buy and then sell when they're worth more at a later date. Alice's strategy would be more like a high yield dividend investor where she's purchasing her stock and then she's collecting income off of that stock every single month. Doug and Charlie's plans are very, very similar. They're taking an active investment strategy. So that would be buying either stocks, bonds, options, and buying and selling those on a regular basis so that you can generate income on a monthly basis. That is active trading. And the risk profiles are different based on what we're actually doing. So even though they're both doing similar things, Charlie's risk profile is different than Doug's risk profile in the two different strategies that they take in comparison to the houses. And that's what we have to look at when we talk about risk in general when we're trading either stocks or options. Anyways, that's it for today's video. Hope you guys are enjoying this. Remember to leave a thumbs up down below, subscribe if you haven't already, and share this with your friends. Let's get rich together.